Welcome back, traders. The final trading week of January started with strong volatility, sending gold above 5,000. That's a historic high for the precious metal as investors keep hedging against geopolitical risks and import tariff threats. The US president threatened Canada with 100% import tariffs if it secures a free trade deal with China. Meanwhile, traders are also expecting a coordinated FX intervention from both Japanese and US officials, which means that perhaps the US dollar could extend further. And all this is happening as the Fed is preparing for its first policy meeting of the year, with the announcement coming out on Wednesday, while on the data front, Eurozone could face GDP growth figures for the final quarter of 2025 on Friday. So let's break down key markets and let's have a look at what's happening in gold, dollar yen, and euro dollar. And starting first with gold, the precious metal had an amazing month. It had an exponential rise to 5,111, and it seems that this uptrend is still looking pretty much well intact. There are no serious trend reversal signals, especially as investors are waiting a dovish Fed in the coming months, persisting geopolitical risks, as well as a potential US government shutdown following the latest shootings in Minneapolis. So all this could add further demand to safe havens, including the precious metals. So we could see this rally stretching even higher. Now, from a technical perspective, we can see that there are overbought signals in the market coming from the RSI and the stochastic oscillator. So a potential breakthrough or a slight pullback cannot be ruled out, especially as we are moving towards the 5,180 zone. That is where the 261.8% Fibonacci extension level of this downfall is placed. While higher than that, I expect the next resistance to come around 5,430. That is another Fibonacci extension of the latest downfall. So these levels might be closely watched if the rally continues. And in the event of a pullback, any declines would cause much stress and could be part of this upward pattern, with the 5,000 level coming first into view. Then below that, support could also come immediately somewhere between 4,750 and 4,860. And then lower than that, the price may attempt to pivot once again near its 20-day moving average, currently seen near 4,600. And there are a couple of support trend lines slightly higher at 4,675. So this region could be also a key area to watch before we head towards this support trend line seen near 4,430, where the 50-day moving average is converging. Now looking at USDJPY, well, the pair has faced a significant decline, a sharp downfall towards the 153.38. That's the lowest level since November, and it came as fears over an FX intervention from both Japanese and US officials hit the headlines. So we are expecting to see some extra volatility if indeed officials intervene. And given that the Fed FOMC policy meeting is also it's also happening this week, with the announcement coming out on Wednesday, then that could cause also fresh movement. The Fed is expected to keep interest rates steady, but given Trump's pressure over lower interest rates, it will be quite interesting to see if some of the policymakers decide to shift to the dovish side or call for lower interest rates. In the event that the Fed doesn't, in case the Fed backs down any pressures over lower interest rates, that could be positive for the US dollar, and perhaps in this case we could see the pair returning above the 153.92, 154.35 key territory. It was a support region back in December. The 38.2% Fibonacci retracement level of this Up leg over here is also in the same territory, so it will be closely watched before we reach again this constraining line near 156.50, which where the 23.6% Fibonacci mark as well as the 50-day moving average are placed. Then above that, the price may consolidate a bit near the 20-day moving average at 157.25 before it retests the lower band of this broken bullish channel near 158.35. And looking for support levels because the technical indicators down here keep reflecting a bearish bias. So if the price falls below the key 153.92, 154.35 zone, I expect some stability near 153 or even lower at 151.50, where the price pivoted back at the end of October. And finally, the 61.8% Fibonacci mark of 150.70 could come next into view. And perhaps we could see the prices falling in this market as the risk of a government shutdown is increasing. We do have more import tariff threats, and potential FX intervention in Japan could actually cause more dollar weakness unless the Fed comes first to pressure the US dollar with a more dovish tone. And finally, looking at euro dollar, which rose sharply to almost reach the 1.90 level earlier today, but in the face of on the back of a weaker dollar, that the pair had an amazing session lately because of the sell-off in the green pack, and perhaps the euro. Well, the euro is also considered the second strongest reserve currency, so. Probably it's gaining demand when other major currencies such as the dollar and the Japanese yen are suffering from stronger political and economic risks. Now, whether this rally could extend further, well, we cannot rule out a pullback given the overbought signals coming from the RSI, the stochastic oscillator down here. So I would like to see a clear close above the 1.8065 and 1.19 level in order to target the 1.9070 and 1.20 constraining zone. And by the end of the week, we are also expecting Eurozone GDP growth figures. The data are expected to show a slight pullback to 1.2% year on year in the fourth quarter. But overall, I don't expect the data to cause any fireworks. It could just allow the ECB to keep interest rates steady and remain in the same path unless we see any shocking downside revisions. And beyond that, the 1.2055 level could be another key territory to watch. This is the line. This is where the line that connects the highs from June as well as September is placed. Now, looking for support levels. Well, if the price pulls lower, I expect some stability to come around 1.1775. That's where this broken resistance trend line is placed. Failure to pivot here could then drive us towards the 20 and 50-day moving averages currently seen between 1.6070 and 1.17. While lower than that, all the eyes will turn to the 200-day moving average. That line managed to save the market from significant sell-off. Actually, it just acted as support, as a strong support as it did back in March. So we can see that following March rebound, the price gained significant ground and continued higher. So let's see if that proves to be the case. Nevertheless, we have another layer of safety slightly lower and around the support trend line at 1.1545. So any failures to hold here could actually dampen market sentiment and cause more declines. So this is everything I wanted to share with you guys. Thank you for watching. Keep a close eye on the geopolitical risks, on the FOMC policy meeting, as well as import tariffs and a potential FX intervention in Japan. So stay tuned for more headlines, for more updates, and we'll be back on Thursday with more technical analysis. Thank you for watching and see you next time.